Welcome back to the channel. Big news from the US Federal Reserve. They've just cut interest rates by a quarter point, their first cut of the year. But instead of cheering, markets looked unimpressed. Today we'll break down why this happened, what it means for investors, and what to watch next. The Fed lowered its benchmark interest rate by 25 basis points, bringing the federal funds rate to a range of 4.00 to 4.25%. This is the first rate cut since December. Alongside the move, policymakers signaled they expect at least 2 more cuts before the end of the year. The decision comes as inflation sits just under 3%, still above the Fed's 2% target, while the labor market shows signs of weakening. Powell described the move as a risk management cut, meant to support growth without losing sight of inflation. Normally, rate cuts send stocks soaring, but not this time. Why? First, the cut was widely expected. Markets had already priced it in. Investors were hoping for a stronger signal of aggressive easing, maybe even a 50 basis point cut. But that didn't happen. Second, the Fed's language was cautious. Inflation hasn't cooled enough to give them full confidence, so Powell stressed that the pace of cuts will depend on incoming data. That uncertainty left Wall Street with mixed feelings. The result? The Dow managed modest gains, but the S&P 500 and Nasdaq showed little enthusiasm. Tech stocks, which usually benefit from lower rates, struggled to rally. Economists call this a balancing act. The Fed is trying to protect a slowing labor market while still keeping inflation under control. One Fed official even dissented, voting for a bigger half-point cut. Analysts say the real story now is data dependency. Every jobs report, every inflation print will influence how many cuts actually come this year. Markets no longer see a guaranteed easing cycle, but a cautious one. End quote. For consumers, rate cuts should slowly translate into cheaper borrowing costs, from mortgages to business loans. But the impact won't be dramatic, at least not yet. For investors, the outlook is uneven. Rate-sensitive sectors, like housing and financials, may benefit. But growth stocks could remain under pressure if inflation stays sticky and bond yields stay elevated. And globally, a softer Fed could put downward pressure on the US dollar, influencing currencies and emerging markets. Conclusion. So, to sum it up, the Fed cut rates, but markets weren't convinced. Inflation is still too high, the job market is softening, and Powell is signaling caution. This isn't the start of a dramatic easing cycle, at least, not yet. What do you think? Was this quarter-point cut enough, or should the Fed have gone bigger? Share your thoughts in the comments. And if you found this breakdown helpful, don't forget to like, subscribe, and hit the bell for more updates on global markets and the economy. Thanks for watching.